What if I told you that the most powerful algorithm shaping your financial future isn't sitting on Wall Street servers, isn't written in Python or C++, and doesn't belong to hedge funds or tech giants, but is already running, silently, inside your head? Before you click away thinking this is another motivational gimmick, hear me out. Every stock you buy, every risk you avoid, every opportunity you miss, every impulse purchase at 2 a.m., every time you panic sell or hold on just a little longer, all of it is being decided by a prediction machine that evolved long before money even existed. And here's the twist. This algorithm doesn't just predict the future, it actively creates it. Today, we're going to uncover the unexpected algorithm inside your brain, how it predicts financial outcomes, how it quietly shapes your wealth over decades, and most importantly, how learning to work with it instead of against it can completely change your financial trajectory. Let's start with something familiar. Imagine you're scrolling through your phone late at night. You see a headline, "Market crashes as investors panic." Your heart rate spikes. You don't even own the stock mentioned, but suddenly you feel uneasy about your entire portfolio. Your brain instantly starts running simulations. What if this spreads? What if my investments drop tomorrow? What if I should sell now before it's too late? None of this is random. This is your brain doing what it has always done best, predicting the future based on incomplete information. Long before spreadsheets, charts, and financial news, your brain evolved to answer one core question: what's likely to happen next, and how do I survive it? At its core, the human brain is a prediction engine. Neuroscientists often describe it as a biological forecasting system. Every second, it takes past experiences, emotional memories, social cues, and sensory information, then generates a model of what it thinks will happen next. In prehistoric times, this meant predicting whether rustling in the bushes was the wind or a predator. Today, that same system is predicting whether a market dip is a buying opportunity or the beginning of financial disaster. The environment has changed, the algorithm hasn't. Here's where things get interesting. In finance, we like to believe we're rational. We talk about logic, data, analysis, and strategy. But the truth is, logic usually comes after the prediction, not before it. Your brain predicts first, emotionally and intuitively, then recruits logic to justify the decision. You feel a stock is too risky, then you look for charts to confirm it. You feel confident about an investment, then you selectively read bullish opinions. The brain's algorithm is subtle like that. It doesn't announce itself. It just nudges you, quietly, toward actions that feel right in the moment. Let's look at a simple scenario. Two friends, Alex and Jordan, both start investing at the same time. They earn similar incomes, invest in similar markets, and have access to the same information. 10 years later, Alex has built significant wealth, while Jordan is constantly stressed, jumping in and out of investments, barely breaking even. The difference isn't intelligence. It's not luck. It's the internal prediction model each brain developed over time. Alex's brain learned to associate short-term market drops with long-term gains. Jordan's brain learned to associate drops with pain, danger, and regret. Same data, different predictions, different futures. This is where the brain's algorithm becomes unexpected and dangerous if misunderstood. Your brain doesn't care about maximizing returns. It cares about minimizing pain. Losses feel about twice as powerful as gains. This isn't just a saying, it's a well-documented psychological principle called loss aversion. If you gain $1,000, it feels good. If you lose $1,000, it feels devastating. Your brain encodes that pain deeply, updating its prediction model. Avoid this in the future. So the next time a similar situation arises, the algorithm leans towards safety, even if that safety costs you long-term wealth. Think about how many people say, "I'll invest once the market feels safe." What they're really saying is, "I'll invest once my brain's prediction algorithm stops signaling danger." The problem is, by the time it feels safe, most of the opportunity is already gone. The brain is optimized for survival, not for compounding returns over 30 years. In the wild, avoiding danger kept you alive. In the market, avoiding volatility can quietly keep you poor. Now let's zoom out. Your brain doesn't just predict market movements, it predicts your identity. It predicts what kind of person you are financially. If you've ever thought, "I'm just bad with money," that thought didn't come from nowhere. It came from repeated predictions reinforced by past outcomes. Miss a bill payment? Brain updates the model. "I'm disorganized." Make an impulsive purchase? "I lack discipline." Over time, these predictions become self-fulfilling. You stop trying to budget because your brain predicts failure. You avoid investing because your brain predicts regret. The algorithm shapes behavior, and behavior shapes results, locking you into a financial loop. Let's talk about a real-world example that hits close to home for many people: salary negotiation. Imagine you're offered a job. The salary is decent, but part of you wonders if you could ask for more. Immediately, your brain runs a prediction. If I ask for more, they might think I'm greedy. They might rescind the offer. I might lose everything. Notice how extreme the predicted outcomes are. Rarely does the brain say, "They'll probably negotiate calmly," because embarrassment and rejection are social threats, and your brain treats them almost like physical danger. So you stay silent. Over a 30-year career, that one prediction repeats itself dozens of times, quietly costing you hundreds of thousands of dollars, not because you weren't capable, but because your internal algorithm prioritized emotional safety over financial upside. Another scenario: debt. Let's say you carry credit card debt. Every month, you promise yourself you'll pay it down, but when the statement arrives, your brain predicts discomfort. It sees the number, imagines the loss of spending freedom, and signals avoidance. "I'll deal with it next month." This isn't laziness, it's prediction-driven behavior. The brain forecasts emotional pain and steers you away from it, even if that avoidance leads to greater pain later. Interest accumulates, stress increases, the algorithm updates again, money is overwhelming, and the cycle continues. What makes this algorithm truly powerful is that it's constantly learning. Every financial decision updates the model. If you invest during a bull market and make money easily, your brain learns that investing equals reward. If your first investment crashes, your brain learns that investing equals danger. This is why first experiences matter so much. A person who invested for the first time in 2009 may have a completely different financial mindset than someone who started in 2007. Same markets, different starting predictions, different long-term behaviors. Now, let's talk about the future, specifically how your brain predicts it. The future, in financial terms, is abstract: retirement, long-term goals, compound interest. These concepts don't trigger strong emotional responses because they're distant. Your brain struggles to emotionally connect with future you. Neuroscience studies show that when people think about their future selves, the brain often treats that future person almost like a stranger. So when you choose between spending $200 today or investing it for retirement, your brain predicts immediate pleasure versus abstract future benefit. Guess which one usually wins? This is why people undersave even when they intellectually understand the math. The algorithm is biased toward the present. It predicts immediate outcomes more vividly than long-term ones. That doesn't mean you're irresponsible. It means your brain evolved in an environment where long-term financial planning wasn't necessary to survive. Food now was more important than food later. Translate that into modern finance, and you get impulse spending, lifestyle inflation, and chronic underinvestment. But here's the turning point in this story, and it's important. The brain's algorithm isn't fixed, it's plastic. It can be trained. Just like machine learning models improve with better data and feedback, your internal prediction system can be reshaped through experience, framing, and repetition. The key is understanding how it learns. One of the most powerful ways to retrain your brain's financial predictions is through controlled exposure. For example, many successful investors talk about the first time they watched their portfolio drop significantly. It was terrifying, but they didn't sell. They watched it recover. That single experience updated their brain's model. Drops don't always mean disaster. The next drop felt less scary. Over time, volatility became normalized. The algorithm adapted. Contrast this with someone who panic sells during every downturn. Each sale reinforces the prediction. Selling avoids pain. Even if the market recovers later, the brain remembers the relief, not the missed gains. This is why habits matter more than one-time decisions. Habits feed the algorithm consistent data. Another way the brain shapes financial futures is through narratives. Humans think in stories, not spreadsheets. If your internal story is, "the system is rigged, people like me don't get ahead," your brain predicts futility. Why invest effort if the outcome is already decided? On the other hand, if your narrative is, "wealth is built slowly through boring consistency," your brain predicts progress through patience. Same external reality, different internal story, different behavior. Think about how financial media influences this. Headlines scream urgency, act now, last chance, market meltdown. These messages hijack your prediction system. They shrink your time horizon and amplify perceived risk. Your brain doesn't distinguish between real threats and symbolic ones. A flashing red market chart can trigger the same stress response as a physical danger. Once you understand this, you realize that managing your financial future isn't just about managing money, it's about managing inputs to your brain. Let's explore a scenario that many people experience but rarely analyze. You get a raise. Initially, you feel richer. Your brain predicts more freedom, more comfort. But within months, your lifestyle adjusts. The new income becomes normal. Expenses rise. The algorithm updates the baseline. This is standard. Now you feel just as stressed as before despite earning more. This is called hedonic adaptation, and it's another example of your brain shaping financial outcomes without your permission. Unless you consciously intervene, the algorithm will always normalize gains and amplify losses. So, how do you intervene? First, by making future rewards feel present. Some people do this by visualizing their future selves in detail. Others automate investments so decisions are removed from emotional prediction loops. Automation is powerful because it bypasses the algorithm entirely. The brain can't sabotage what it doesn't get to decide every month. Another way the brain shapes financial futures is through reframing losses as data instead of failure. When an investment underperforms, instead of saying, "I'm bad at this," say, "the model learned something." This subtle shift changes how the brain encodes the experience. It reduces emotional weight and preserves curiosity. Over time, your brain predicts learning instead of pain when facing uncertainty. Third, by deliberately slowing down decisions that trigger strong emotions. The faster a decision feels, the more likely it's driven by prediction shortcuts rather than analysis. Creating a pause, even 24 hours, allows the rational part of the brain to catch up and update the model more accurately. Let's bring this back to the big picture. Your financial future isn't just the result of income, intelligence, or opportunity. It's the compounded result of millions of tiny predictions made by your brain over time. Predictions about risk, predictions about self-worth, predictions about what's possible. Most people never question these predictions. They assume they're reality. But once you see them for what they are, probabilistic guesses shaped by past experiences, you gain power. Think of your brain as an algorithm you inherited, not one you consciously chose. It was optimized for survival in a different world. In today's financial system, that same algorithm can either be a silent saboteur or your greatest asset. When you learn how it works, you stop fighting yourself. You start designing environments, habits, and systems that feed it better data. And here's the most unexpected part of all. When enough individuals change their internal prediction models, markets themselves change. Investor sentiment shifts, risk tolerance evolves, innovation accelerates. In that sense, the algorithm in your brain doesn't just shape your personal financial future, it participates in shaping the collective economic future. So, the next time you feel fear watching the market move or hesitation when an opportunity appears, pause and ask yourself, what is my brain predicting right now? Not what is true, but what does my internal algorithm think is true? That single question creates distance, and in that distance lies choice. Because once you realize that your brain is constantly writing the future in advance, you also realize something else. you can edit the code, slowly, imperfectly, but deliberately. And over years, those edits don't just change decisions, they change destiny. If you found yourself nodding along at any point, it means you've already started updating your model. And that, quietly, is how financial futures are rewritten, not by sudden windfalls or secret strategies, but by understanding the unexpected algorithm that's been with you all along.